Hello and welcome to another live technical analysis. We will be starting off with the EU50 cash or aka Euro Stocks 50. The Eurozone's revised GDP rates for Q2 were released approximately 13 minutes ago, came in as expected, and thus we are seeing a bit of a support in the Euro Stocks 50. Wouldn't be surprised seeing some support in the euro, perhaps in the 15-minute time frame. Not even. The euro is weakening against the US dollar and appears to be continuing to do so. Euro Stocks 50, though, different story. Inflation appears to be on track. Eurozone economy seems to be doing all right. The issue is industrial production, which came in at minus 2%, which is lower than expected, and might be a bit of an issue in terms of industrial production in the zone. Nonetheless, you can see that the R1 resistance line that we had placed together during yesterday's live technical analysis has now been validated. Note the wick of this daily bullish candle testing RR1 level and meeting resistance. Now, this is a swing low. Would not be surprised to see a retracement perhaps up to the mid range of the Bollinger Bands, maybe even R2 before the Eurostox 50 continues on its descent, as we did have a death cross. Now, actually, that was not a death cross. Actually, uh, 50 crossing now, that was bullish. Bullish bands are tilted towards the downside. They are sized at 42, which does imply relatively bearish market sentiment. Nonetheless, it will be very interesting. If it does break above R1 at 4,800, we would opt for a bullish outlook up until R2. But to be confirmed as a bullish outlook, we would require a clear break above R3 as well. So we do have those resistance levels. On the flip side, if it reverses course and moves below S1, we would maintain and opt for a bearish outlook, taking aim for S2 at 4,655. Rather than that, we have 4,580. So that's it for the Euro stocks. Euro USD, which we touched upon moments ago, does appear to be moving in a relatively downwards fashion. We were on the 15-minute time frame. Let's go to the 4 hour. On the 4 hour, it's broken below that S1 level of 1.0600. Note those two wicks pierced through, broke below, maintaining a bearish outlook for the euro against the US dollar, with the next potential target for the bears being that S2 support line at 1.0440. So maintaining a bearish outlook. Now, in terms of technical analysis, we do have to flip the support level to resistance. So from green, it turns to red. And then we need to readjust our text labels as well. We could even bring that R3 level down to this high, as the price action is now moving lower and lower. So this becomes R1. And now we'll be wasting approximately 2-3 minutes just editing these text labels. That is one of the, let's say, downsides of MT4. R2, and then R3 1 point. We could bring this lower. This side here at 1.0930. That would be our R3 resistance line. And then we can keep that outline just in case we need it sometime in the future. Makes it easier for us. And we also have a reference point. But for now, we've placed the new R3 resistance line at 1.0930. We have R2 at 1.07550 and R1 at 1.60. We have S1 at 1.0440, which is the next potential target for the bears. Look at the daily candlestick. Downwards motion, RSI is below 30, which does imply a bearish market sentiment. Now, if it moves below, I'd say, or moves towards 25, it might imply that the pair is oversold and might be due a correction to higher ground, which could be that R1 level. So I would be trying to see if there is a swing low being formed, and then we could see a potential retracement. S3 becomes S2 at 1.0220. The question now is, where are we going to be placing that S3 support line? Which means we need to move back and look at the historical price action of the euro against the US dollar, and then we need to determine upon a level upon which we would be placing that S3 line. We can see that there was a high here being formed, but if we look closer, it is too close to S2 when compared to S1 and S2, and thus we would like to see a bit more distance between S2 and S3. That means I'm going to be looking at something a bit lower, and you can now see my cursor, which is an improvement from yesterday. We're moving it lower. So taking this point here, you can see it's not that far away from S1 and S2 in terms of the distance, but it still provides the pair with some leeway for it to move. Now, why are we placing our S3 support line at this particular point? I would implore you to look at this bearish candle and this bullish candle. It closed and opened on this line, which does imply that this was a support level. This wick was seeking liquidity from this bullish candle here before moving higher. And thus, this would be my S3 support line, which is very, very close to that one to that one significant mark. Excuse me, that 1 euro would be equal to $1. So essentially achieving almost parity. Very significant. It's a key psychological figure. Anything lower would be very concerning as well. But it's at 1.0005. Let's see. No, that's wrong. Excuse me, not 1.005, 1.0010. Almost achieving parity. If you're traveling to the US and you're from Europe and you're looking to exchange euros for dollars, that would not be a very ideal situation for you. And now we need to readjust that R3 resistance line, flip that to a support, that is S3. And we are placing our support level, which we just indicated. So we have R1, R2, R3, and then the support levels. So we are maintaining a bearish outlook for Euro USD. We do have the PPI from the US being released later on today. Now, for the CPI rates yesterday from the US for October, which were released, they came in as expected. I'm a bit concerned about the acceleration of inflationary pressures. Now, here is where we're seeing that death cross being formed. Euro USD, 50 moving average closing below, about to close below that 100. Moving average, concerning long-term bearish outlook for the pair. Now, it is exceeding the lower band of the Bollinger Bands, which also coincides with the RSI being below 30. So at some point, perhaps between S1 and S2, we might see a retracement to higher ground. Yes, for the CPI rates of the US, 2.6% is an acceleration, but the markets are pricing in an 80% probability for the bank to cut 25 basis points in their meeting in December, so the last meeting of the year. There is a bit of an issue. The sentiment that is emerging from Fed policymakers does appear to be making calls for a hold. So the market expecting 25 basis points in terms of a rate cut might be a bit optimistic. CPI is at 2.6. The economy isn't doing that bad. And then you have Trump's economic policies, which could increase inflation pressures in the future. So if you ask me, I would opt for a hold in the bank's next meeting. But the implications of a potential 25 basis point rate cut are not really being reflected in the particular FX markets. In theory, a rate cut could weaken the US dollar and thus could allow other pairs to gain. Whereas this is a different story. Look at the USD JPY, Euro USD, cable as well, the Loonie, the CAD, excuse me, the Loonie, the Aussie, the Swissy, the Kiwi as well. The dollar is strengthening across the board. So that does not appear to be making that big of an influence in terms of the FX markets. For the USD against the JPY, that upwards moving trend line continues to be validated. The RSI is at 67, which does imply also a bullish market sentiment. Having cleared that R1, our target is R2 at 158.35. For Japan, we would like to note the GDP rates for Q4, which are due out tomorrow. Now, they're expected to showcase an expansion of the Japanese economy, albeit at a slower rate. Therefore, a bit of a slack, well, not a slack, but in terms of the Japanese economy, maybe weakening slightly. It is expanding, but still there are some concerns which could further weigh on the JPY. So we might be seeing the dollar gaining against the JPY. For today, and one of the key highlights of today will be Fed Chair Powell's comments. So he is speaking later on today at 10 p.m. GMT plus 2. So you can readjust that to your own time zones and see where Fed Chair Powell is speaking. My personal opinion is that the Fed Chair will urge caution for the markets, that the fight against inflation is not over, which could be perceived as relatively hawkish in nature, and thus could actually aid the dollar. If he is dovish, it could weigh on the US dollar, But I think the Trump trade, which is seeking its way into the FX market, is still ongoing. You could also see that from the crypto markets. It's being discussed on Bloomberg, Reuters, the Financial Times, the Wall Street Journal. Everyone is discussing the Trump trade. The positive implications on the dollar and the US economy do appear to be continuing following the election of Donald J. Trump as the 47th President of the United States of America. From a technical perspective, USD we were noting that it was moving in a relatively sideways fashion, but that's been cleared. We are maintaining a bullish outlook. Now, R2 is the next potential target. After R2, so 158.35 and close to 162, we would not be surprised to see a government intervention in support of the JPY. Its significant weakening of the JPY against the US dollar might be concerning for the Japanese government. So I would be very, very cautious between R2 and R3, and that is my own personal opinion. Higher than R3 would be hypothetical resistance level. Let's say that it has about $4 between R2 and R3. I'd place that at 166. So $4, yeah, 166 would be the potential R3 level. And let's just place that so we do have it in the event that it does move to that level. And that is would be red. So this actually becomes R2. Our old R2 becomes R1, old R1 becomes S1. So we're simply readjusting our text labels once again. We will be looking at gold, oil, of course, the S&P 500, the Nasdaq, the Dow. If there is anything you would like us to cover specifically, feel free to ask and we'll have a look at the technicals. We can open the charts as long as we are offering that on our MT4 platform. Then we can open the chart. We can add some indicators depending on the instrument. We could do Ichimoku. We could do OBV. I wouldn't do Williams percentage R, but we could look at some other indicators. And that becomes S2. This becomes S3. This becomes S4. And then we will be placing R3 at 166. 66.00. And that is now red, not magenta. And that becomes red. Nice. Cable has broken below that S1 support level, which we placed at 1.2675. So, same story with the euro, maintaining a bearish outlook for cable as well. This now becomes resistance. The next potential target for the bears could be at 1.2515. So keeping an eye out on the pair's price action and how it might react to that potential resistance level, which we have placed. But overall, you can see from our various lives, and this is live. You can see that it is moving. I can go to the 5 minute time frame. Voila, it is 1.2636. For today is the 14th. And you can see from the lives that we do place these together. And then when we do come back to them, we are fairly and quite spot on most of the time in terms of the support and resistance levels. And that can be tested by looking at our lives and seeing support and resistance levels which we placed months ago that come back into play and then are validated again. Now we are using the daily time frame, so that does give us a lot of leeway. Means we don't really have to change that on a daily time frame, but it is good for us to gauge the predominant trend direction, so bearish or bullish. I do need to compact the chart a little bit so that we can make space for the incoming S3 support line. Now, you can see where S1 was placed to the left of your screens. Note my cursor. And this is S2, the wick. And now we do need to find S3. And then we go back and we'll do what we did yesterday. We'll place in a rectangle which will show the price action we are looking at. So on your screens, as I can see as well, you're seeing a rectangle that has been formed. This is the price action that we are currently looking at in order to gauge upon where we should place our support level at S3. We could also measure the distance between S1 and S2 to have a clearer indication, which is around 204 pips. And then we can not place a line. We can take our measuring tool, somewhere. So this was 227 pips, roughly. Somewhere around here. Makes sense that we place our S3 support line. The way I want to find that S3 support level is I want to take as many candlesticks as possible that seem to validate that support level. Because you can see some of them are wicking lower. One could use candlestick theory and say, look, this was a reversal, this was an inverted hammer, this, that, and that, hanging man. I want to see the price action. I want to see a level upon which the price reacted. And that could be upon these two candles here. So let's test that theory. I am placing a line. Let's see if it can coincide with the closing of this bearish candle. Wicked found support, so that could be one option. Another option, it could be slightly higher, which actually isn't that bad too. Or we could place our support level at this lowest point, and then we can keep a text box and showcase the distance between the two as a potential support zone, which is what I might actually do. I want to be a bit more certain, like the two touches, and a third. This looks actually nice. I have one, a second, a third, and a fourth. So we will be placing that S3 line at 1.2090. But for future reference, I will be keeping this rectangle in play. And I just need to make sure that it is covering this wick here. And then I will come back and make sure that that is accurate. So this could be a potential support zone. I'll keep that in play. So this could be essentially, you could see the candle closing potentially on the S3 line, and we might see a wick dipping down into this rectangle to seek some liquidity. So we will keep that up until it becomes invalid. If it does become invalid, it would be a very nice reference for us, something we can use in the future as well. So I've placed that S3 support line 1.2090. So we've done cable. We should move on to the loonie, US dollar against the Canadian dollar. Broken above R1, same story. Resistance turned to support. Now, there was an IEA report that came out approximately an hour and a bit ago. It does imply potential reduced demand for oil in the future. I have not seen that report. I've seen some reports, but I would like to see it personally before I am confident that that is what it actually said. Sometimes the truth might be distorted, or some phrases might be taken out of context. So take what I say about the potential IEA, about the IEA report, with a pinch of salt. And yeah, we'll be releasing our weekly oil outlook report today, and I will be touching up on that report, so making sure that it is correct and providing my own opinion. In terms of support and resistance levels, we've placed S1. Look, it's cleared it. It's moved higher. It opened on it. Looks like support. That is S1. I'm keeping S2 at 1.4115, keeping the R2 level as well. I do need to seek R3. So we are moving once again back in time. And now that I look at it, we could bring that R2 a bit closer. Might need a bit of a readjustment for the rest of the resistance lines. And price action is at 1.4015. It's finding this. What if I placed? No. That's a nice resistance level. But then R2 would be around here. Look, I'd rather keep that resistance line as we had it before. The side with the wick makes a bit sense. This is a resistance zone, of course. We can keep R2. That would be too close to that R1. But then the question is, where would we be placing that R3 line? It's 123 pips. That's a bit closer. We need to find resistance. But then is that only too close? But if we do place that our resistance, so we can, to explain, I am looking at this bullish candle, validated by this wick, so seeked, found resistance. But we also had placed with these two wicks that old resistance line at R2 at 1.4270. It's a bit too close for comfort. We could readjust that R2 line, and I think we probably might. It was validated on 3 occasions. Let's clear this. Let's remove that R2 and then let's have a fresh look at the chart. Let's remove R1 as well. Right. So here we have a descending triangle, trend line. 3 touches to be validated, 2 to be formed. And then if you had placed this, descending triangle, more than fair. But we are using the recent price action for that support level. Now, somewhere around here, we do have 2 resistance levels. The price action is currently, and let's denote that in another line, turn this to blue. So this is where the price action currently is. This could actually be indeed a resistance level, but it's currently on it. So even if I do place it now, it could easily be invalidated within the next 4 hours, 1 hour, or even 15 minutes. So I would like to look for something that is a bit higher. I have 3 highs, 1, 2, 3. So somewhere around here, there is a resistance level. The question is where? And here is where we have to look and see with the candlesticks and the price action, what would the ideal resistance level be? The first one, send this to red. I'm ignoring this bullish candle, but you can see from this price action here, this was a nice resistance level. Recent bearish candle moved lower. Let's keep that at R1, not that far away from the price action. For R2, let's see. Too close. Ideal. High, the formation of a downward moving trend line. Let's keep that as R2. And let's look for R3. R3, if I simply use this wick, it's irrelevant. There's nothing else that's testing it that was near. I'll have to go further back to validate that. However, if I take this candle here and keep that as R3, issue is there's a bit of a distance between R2 and R3. But for now, we can keep that, and then maybe we can readjust, or we could go further back. Too close. So let's keep that for now. Let's see. And we don't have the historical data. I would have preferred something in between, but for now we might have to keep that resistance level. 1.4342 or 1.4340. Let's make sure that is actually where we had placed it. Hasn't really moved. Yep, that's okay. That's R3. It's a bit far away from R2, which is something I don't really like. and then this becomes 1.4200. It's a nice round figure as well. Psychological impact. Algos as well might seek that level. And then 1.4088. So that's S1, S2, S3. And now we do have R1 as well. So we've done USD CAD as well. Aussie moving lower. Target is S3. 0.647, that's broken. Target is 0.636. Swissy, but to break that R2 level, 0.8920. Higher than that is 0.9050. And I will implore you to see how the price action has reacted to our resistance level. Taking aim for R2, 0.8920. Kiwi moving lower, testing that S3, 0.585. Once again, daily candlestick, testing that support level. I had placed it and looks to be valid as well. Crude oil moving in a relatively sideways fashion between 64.60 and 72.10, so that remains steady. Gold broken below 2,600 and is now apparently heading for 2,470. Intel going back up that 2470, so retracement moving higher. Microsoft finding resistance at 425.05. Nvidia, 50, relatively sideways. ExxonMobil bouncing off R1, taking aim for R2, 122.95. FTSE, predominantly sideways fashion. Tesla finding support at that old R3, turn to support, 290, not 299, 327.78. That is wrong. Change it, but we would have to focus on Tesla and then stocks. It's old R3. McDonald's, hammer, swing high, inverted hammer, reversal formation. RSI 50, not that bullish. Gap might be filled at some point. Japanese stock market, ooh, that's nice. Upwards moving trend line from here. Bullish. Would need to clear, though, that 40,149 level. But overall, that's nice. It'd be an ascending triangle. IBM. Gap being filled. Let's see what they do today. LVMH heading for that old support and resistance level at 594.54. China's economy, will see actually the retail sales rate tomorrow. So that might be interesting for LVMH, increasing retail sales rate. And if we see an uptick in China's economy, maybe LVMH might find some support because it's a luxury goods brand and it has a lot of sales in China. Therefore, the implications of an increase in consumer spending, aka retail sales, could potentially imply an increase in demand for luxury goods and thus might aid LVMH. But overall, it's still a bit of an issue. Google moving higher, finding resistance at that old R3 level we had placed together. That is way back. 181.48. If it does clear that R3 level, we do have a R4 at 188.27. So we are maintaining a bullish outlook for Google, but might be due retracement back down to 173.76, 173.63, which was our old R2, now turned to our old resistance, now turned to support level. Deutsche Bank staying between that old R3 level, no, that R2 and R1. JP Morgan, it might be due a retracement to lower ground. Dow Jones 30 finding resistance. This was actually resistance turned to support, now turned back to resistance. 42,675. Bullish outlook would like to clear that R2 level. FTSE, no, not FTSE, the Nasdaq 65, gearing up potentially for another all-time high. But we do have technicals for the S&P 500. The RSI is still at 67, which does imply an overall bullish market sentiment. It hasn't cleared this week. So if I was looking for a reversal, I would have wanted yesterday's daily candlestick to have cleared that bearish candle. So closing below, it did not. Instead, it ended in the greens. Today also a bit in the greens. Taking aim for a new all-time high, potential resistance at 6,050. Higher than that, 6,200, and then 6,350, which are hypothetical resistance levels. But let's see how it acts to that. Then, yep, we've essentially done it. Boing. Boeing's fall is something that should be studied in economic textbooks. That's bad. Looks bad. We're on a weekly chart as well. The RSI is at 30. Strong bearish market sentiment. These lines that we've placed irrelevant here. Not looking good. But we will be keeping an eye on the Euro stocks. Note it is testing our resistance level. And that is mainly it for today. Thanks for tuning in, and we will see you all next week.
Okay, let's go ahead and get started. So as per usual, a risk warning and disclaimer. All products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, and you should ensure that you understand the risk involved. A disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just a personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein, and redistribution of the material is strictly prohibited. Okay, we have some viewing from Philippines. Hi, good afternoon, and Nigeria as well. So, very good morning to you. Okay, let's go ahead and get. Okay, so I'm Melanie. I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to look at how to apply the ICT strategy, the action plan, liquidity pool manipulation, stop hunts, and market structure. So we'll look at how to overcome all of that and how exactly we can use ICT trading. Okay, so let's briefly do a quick recap for those of you guys who weren't here with us in our the first session. So let's define what exactly we mean by inner circle trading. So it's a trading methodology that focuses on understanding the inner workings of the financial markets. So it's actually now going to become one of the most popular trading strategies since it focuses solely on price action. Originally created by Michael Huddleston, it was made to trade the forex market, but traders are using the same strategies to make profit in all and any market that they trade. So it involves analyzing market dynamics, identifying supply and demand zones, and we'll look at what exactly we mean by those in a little bit, and utilizing price action analysis to make informed trading decisions. So why is this important? So in today's highly volatile and competitive financial markets, having a deep understanding of how the markets operate can give us a significant edge as traders. So since ICT, as we mentioned, focuses a lot on looking at the price action, so it focuses on technical analysis, operates under the premise that by studying the price movements, support and resistance levels, which are also known as your supply and demand zones, and order blocks, one can to some extent pinpoint the areas with the highest liquidity concentration, and consequently forecast emerging trends. So I'll talk a bit about what we mean by liquidity concentration in a bit. Um, but yeah, so by mastering these ICT techniques, it's kind of a way to enhance our ability to identify high probability trading opportunities and also manage your risk all at once. So let's go through a quick recap on the key concepts of ICT trading. Um, okay, so firstly, we have liquidity, displacement, market structure shift, inducement, fair value gap, optimal trade entry, and balanced price range and order blocks. Okay, starting off with liquidity. So there are two types of liquidity, the buy side and the sell side. Okay, please ignore the second line. So buy side liquidity basically represents the level on the chart where short sellers will have their stops positioned. Sell side liquidity will obviously just be the opposite of that. So it represents a level on the chart where long buyers, traders will place their stops. In both cases, these levels are often found at or near extremes at the tops or bottoms of the ranges and are often viewed as areas where traders are proven wrong and therefore will want to get out of their trades. So this is an example. So you can see another way of saying it if you've been here through our webinars for a while, it would just be the swing highs and the swing lows of your chart. Very simply put. But basically, the understanding behind this is that the nature of this concept is that it'll commonly accumulate or distribute positions near levels where many stops reside, which would be at the swing highs and swing lows. So the sheer amount of stops at key levels allow a larger player to fully realize their position. Once that level at which many stops are placed has been traded through, it's often that price will reverse course and head in the opposite direction, seeking liquidity at the opposite extreme. So since, of course, we might not, as individual traders, we might not have as much capital as the larger players, such as your banks, and government agencies, obviously you would just want to follow these areas where they're most likely to place their stops and then expect price to reverse course, head in the opposite direction, and follow these liquidity areas. Next key concept that we're going to look at is displacement. So displacement in short is a very powerful move in price action, resulting in strong selling or buying pressure. So generally speaking, displacement will appear as a single or group of candles that are all positioned in the same direction. So you can see that here. We have a strong selling pressure, so we have a downward movement for the candlesticks. Strong selling pressure here as well. We see the three candlesticks moving in the same direction. Strong buying pressure as well. We see that same upward trend. So this can also be really closely linked to your candlestick shapes. If you guys were here for, I think, one of our recent webinars where we went through the different shapes of your candlesticks, those are really good to use as well in addition to identifying displacement areas. Okay, so these candles typically have large real bodies and very short wicks, as we see here. And it suggests that there's very little disagreement between buyers and sellers. So often a displacement will occur just after a liquidity level. So as you mentioned earlier, liquidity level is basically at your swing highs or swing lows. Once that level has been breached, once price has reversed off of those levels, then it will often result in the creation of both a fair value gap and a market structure shift. So we'll get into those concepts in a little bit. Any questions so far about displacement and liquidity? Okay, if not, let's move on. So next, let's look at market structure shift. So an uptrend is basically when price is making higher highs and higher lows, and a downtrend would simply be when price is making lower highs and lower lows. So in short, you can see how we identify the market structure. So the swing highs and your swing lows just have to be pretty significant. So this plays into any kind of analysis, not just for ICT trading strategy, but also if you're just using your Fibonacci, for example. You would want to look for a chart that has a very clear market structure with clear swing highs and swing lows, so that's easier for you to draw your Fibonacci levels, do your analysis on your support and resistance levels, um, finding your trends, and so on and so forth. So here's an example of a pretty clear market structure. Okay, you can see price generally moving in a downtrend. And here, another way you can identify your market structure or the trend is by drawing your trend lines. So what makes a valid trend line is basically if there are at least three touches on your trend line. If it's a downtrend, like we see here, we would be expecting your touches to be below or on the underside of your line, like we see here. Okay, so you can see it's drawn underneath it. And if it's moving in an uptrend, we would draw it below on the underside of the price structure. Okay, so this is an example of the market structure shift since price is or it has been moving in a descending trend line as we see from these three arrows. But once we start to see price breaking out of your descending trend line, or any kind of um, momentum indicators. And we'll go through some examples of momentum indicators that you can use in a little bit. But for this example, we can see price poking out of the descending trend line. So it's breaking out of this downtrend, right? So it suggests a shift in market structure, suggests that price might see an uptrend start to form, okay? And so this is an example of a market structure shift. Okay, next, let's look at inducement and fair value gaps. So starting off with inducement, price rarely moves in a straight line. So within a larger trend, there are almost always counter trend moves. And these counter trend moves are the result of lower time frame liquidity hunting. Okay, I'll get into fair value gap in a bit, but here's the example of an inducement. So it's basically as you can see from the chart, it basically occurs when price bounces or gets rejected, and then it targets a previous short-term high or low before continuing in the same direction as the longer-term trend. So the longer term trend in this example is pretty bearish. You can see price moving in downtrend, and you see the shorter term price movements or inducement areas is basically when price moves above this resistance level, this very slight resistance level from that small swing high. If we look at the subsequent price movement as well, price breaks above a smaller swing high, and those areas that we've circled are basically the areas of inducement. Okay, any questions so far about market structure and inducement? Okay, all good. Okay, looks like everything is okay. Okay, so we're gonna get into the part that's a little bit more complicated. Okay, let's talk about fair value gaps. So going back to our previous slide, so fair value gaps are basically created within that displacement that we talked about earlier. Okay, and are defined as, yeah, not yet. Okay, cool. What was I talking about? Oh yes, so fair value gaps are created within the displacement that we talked about earlier and are defined as instances in which there are inefficiencies or imbalances in the market. So these imbalances are visualized on the chart by a three-candle sequence containing one large middle candle whose bordering candles, upper and lower wicks, do not match. So again, this kind of plays into that candlestick shape. Um, Let me see if I can find an example for you guys. But I think we have some examples here in this chart. Okay, so let's look at the fair value gaps that have been filled first. Okay, so um, so it basically refers to the gap that occurs when market moves so quickly in one direction that there's an imbalance. So this normally happens when price is moving in a trend, so a downtrend or an uptrend. In this chart that we're looking at, we're seeing price move in a it's kind of ranging, but we see general downtrend. How do we know it's a downtrend? Because price is making lower lows, and lower highs as well. Okay. So this is typically looked at on the lower time frames. So this could be like 15 minute, maybe 30-minute time frame, or even 1 hour to 4 hours. It normally won't go below 15 minutes because then the chart gets a little bit more difficult to analyze. Okay, so if we look at the fair value gaps that are unfilled, okay, um, so the FVG or fair value gap here is basically visible, okay, the areas that we've highlighted, and the areas where the candles don't overlap with each other. Okay, so it's basically these areas where we don't see any candlesticks overlapping. So that's pretty straightforward. The significance of these gap areas is that the idea is that the market might revisit these gaps to fill them in. So that means that price could return to these levels to balance out the previous supply and demand of those levels. Okay, so that means traders often will try to find potential entry points to join the trend or catch that reversal towards these areas. These fair value gaps have been filled, and you can see that there's an overlapping candlestick with that previous candlestick. So here you can see that candlestick overlaps with the previous one, here as well overlaps, and lastly here it overlaps as well. So the trading strategy that you could use over here, for example, would be waiting for price to fill these gaps, these unfilled gaps. So after identifying these gaps, you'll wait for price to return to that area. If price begins to retrace into these gaps, then you can look for confirmation signals. So it could be like candlestick patterns, or you could use other indicators like your momentum indicators to enter the trade. Okay. Yeah, I hope that I explained that pretty clearly. Okay, let's move on. So the next key concept here is optimal trade entry, and we'll talk about Fibonacci in a bit. So if you're just unfamiliar with it, we will go through it in a bit. But basically, according to the ICT trading strategy, the best place to get into a trade can be identified by utilizing the Fibonacci between the 61.8 and 78.6 level. Okay, that's pretty straightforward. So next, balanced price range and imbalance. This is pretty closely linked to your fair value gaps since it's a result of that imbalance. Okay, so it's a result of an aggressive move up that's immediately followed by an aggressive move down, or vice versa. So an aggressive move down that's immediately followed by an aggressive move up. What's left of either of these instances is essentially a double fair value gap, which we talked about earlier. So these act as a magnet to the price before continuation move higher or lower. Balanced price ranges can sometimes signal the beginning of a market structure shift, and the price can often retest and reject from these areas. So most of these, this last concept we've already covered in our previous slides on market structure shift and also fair value gap. Okay, so now let's talk a bit about Fibonacci retracement since we mentioned the 61.8 and 78.6. So if any of you guys aren't too familiar with Fibonacci, we will do a very brief intro to it. So here's kind of a checklist to follow if you're just starting out. Firstly, we want to look for clear market structure. So we're looking for any clear big zigzags or any swing highs or swing lows. And we've shown you examples previously already. Next, we want to identify the recent trend. So is price moving in an uptrend or a downtrend? Okay, and it's important to always follow the general trend. So if price is moving in an uptrend, we would go in for a buy. If it's going in a downtrend, we're going for a sell. Unless, of course, you have analyzed it and you have very compelling reasons that you think price is going to reverse or bounce off a specific level. Yeah. Otherwise, we'll follow the trend. Number 3 is to identify recent major swing lows and recent major swing highs. And lastly is to connect the two extreme points, like you see here, starting from the highest to lowest in a downtrend and the lowest to highest in an uptrend. Okay, so there are a couple of different ways that we use the Fibonacci retracement tool, but I'm not going to get too in-depth into it for this webinar session. I'm just going to focus mainly on the Fibonacci retracement technique, which focuses on the mid-range levels. So that's namely from 0% to the 100% over here. Okay, so the levels that we look at normally would be 23.6, 30.2, 50, 61.8, and 78.6. Okay, and for ICT, they recommend you to go in between these two levels here as your entry. So some examples of how you can use a retracement. Price, you can see, rebounds off of the highlighted area at 61.8 level. Okay, so that's basically how you use Fibonacci. You can see we are following the shape of the price structure pretty closely. Starting point here, ending point here. See price rebounding off at the 61.8% level. Okay, so what does smart money look like in price action? So there are a couple of um terms that they use that's pretty similar in concept, like conceptually, to what we already have been going through in all of our previous webinars. So for example, if we're normally like when I analyze or when I do my live analysis sessions, I will call certain areas support and resistance. They would call it supply and demand areas or your order blocks. Okay, so that's just simply a replacement or a different term for supply or demand and that an asset experiences. Breaker block or mitigation blocks. So this is what is traditionally called your support and resistance levels as well. It's just all following the order block um term. And then flip zones are basically the levels where you can expect price to reverse off of. Fair value gaps, we've already talked about them based on the imbalances on the market when demand outpaces supply or vice versa. And liquidity grabs rather. So let's talk a bit about liquidity pool manipulation. So liquidity pools basically refer to areas on a chart where significant clusters of buy or sell orders are located. Excuse me. Excuse me. So these liquidity pools act as magnets for your price. And they represent zones of substantial market interest. So by identifying liquidity pools and understanding their significance, traders can anticipate potential price movements and position themselves accordingly. So we already talked about liquidity in the first few slides, but this is just kind of a recap for under smart money concept. Okay, so let's talk a bit about how you can manage your trades while using your ICT. Okay, so just very quickly, why is it important to have trade management strategies? Firstly, is to control risk. So trade management strategies, such as your stop loss orders and position sizing, can help traders to limit their potential losses and manage overall risk exposure. Maximize profits. Of course, it enables you to lock in your profits and maximize returns using take profit orders and trailing stops. And trailing stops is going to be something that we're going to talk about in a bit, where we're going to talk about how you can use certain indicators or momentum indicators to confirm your trade after you've used ICT to analyze as a technical form of technical analysis, then you can use your indicators to confirm that analysis. Number three, manage emotions. So, of course, even in volatile markets, these can prevent impulsive decisions that's driven by fear or greed. So, having a specific structure and trade management techniques and rules that you stick to can help you to stay calm and rational. Improve trade efficiency. So by having a well-defined trade management plan, traders can make faster, more informed trading decisions and avoid the cost and time having to constantly monitor and adjust their positions. And lastly is increasing consistency. So when you follow a set of rules and you're consistent over time, you can reduce the impact of your individual losses and maximize the impact of your winning trades. Okay, so let's start off by going through the issue of having a fixed take profit or stop loss. Okay, so let's take a look at this example. The red area shows a strong resistance area since there have been two swing highs that are in line with that area. So if our trading strategy requires us to have a fixed take profit of 100 pips, we will place the target beyond that strong resistance area. Okay, so let's see how this plays out. So price shot up. It missed our target profit by a few pips before reversing back down. Okay, reason for this is that price tends to reverse off of really big areas of resistance and support. Now, in an alternative scenario, if we had placed our take profit before the key resistance area, we would have gotten a profitable trade. So it's important to look at the charts and adjust your take profit and stop loss accordingly instead of just blindly following a fixed target profit of 100 pips, for example, just because some forum tells you to do so. Okay. Okay. So what is the proper stop loss take profit placement? So this is just a guide, but we normally will recommend you to place your stop loss beyond and your take profit before. So what does that mean? It basically means, okay, here we're talking about Fib confluence. Basically, Fibonacci confluence occurs when you have two or more Fibonacci levels that line up, which basically suggests that price will be attracted to these areas. So, but this also works for strong resistance areas or areas where you are predicting areas of strong supply and demand. Yeah, you get the idea. So it works for any kind of um, big areas that you're looking at, not just Fibonacci confluence areas. So we would place our stop loss beyond these areas because price is more often than not attracted to such areas of confluence or resistance or support, supply or demand, whatever you call it. And if your stop loss is placed right before instead of beyond it, you'll most likely get stopped out right before the market starts to reverse. Okay, so that's one of the reasons why people start to complain about stop hunting as well. And if you are talking about take profit, we'll place it before any big resistance or area. And reason being is that when price reaches these areas, there's a high chance it won't be able to go beyond it. So instead of reaching your profit target, it reverses back to your entry or even worse, your stop loss. And that's one of the reasons why people complain that the market is being manipulated because they might miss their take profit by 1 or 2 pips. Okay, so the example that I have here, you can see if we're going in for a buy entry, for example, we'll place our take profit below the confluence area and your stop loss would be below as well. Now, if we are looking at a sell entry, for example, you would place your take profit above, stop loss above that major resistance area. Okay. Okay, so let's now talk about the problem with a fixed stop loss. So in this example, you can see we have a nice support level with 2 swing lows. So this, if we're looking at the ICT trading strategy, we would label this as one of your liquidity areas. So you can see it's pretty much the same concept, just with a different names. So you have a nice support level here. We're expecting price, which is here, to continue all the way up to this swing high. So our strategy has a fixed stop loss of 100 pips, which is right above this support level. Okay, so instead of going up, price goes down instead, touches the stop loss and bounces perfectly from the support. So what we should have done instead was to place our stop loss slightly beyond the key level of support or resistance, so that we don't get stopped out, and so that we're giving price more room to bounce off of that level and hit towards our take profit. Okay, so what should we do instead? So that's why it's important to have a dynamic stop loss and take profit placement. Okay, so we'll go through a couple of examples of dynamic stop loss placements, different techniques that you can use for risk management. Okay, so why is it important? It's used to manage risk. The level of the stop is continually moved to a more favorable position as the price of an asset moves in the desired direction. The goal of the dynamic stop loss is to lock in profits while minimizing potential losses. And lastly, the placement of the stop loss can be determined by various technical analysis indicators or market conditions, such as volatility or market trend. Okay, so here's our first example. So this demonstrates your dynamic stop loss. So price here has bounced off nicely off of that support level at 86.721. And we're expecting it to reverse off the entry at 87.8, in line with the 100% Fibonacci projection level. Okay, so here you can see we have another couple of Fibonacci levels that line up. So, and it lines up with this swing high as well. Okay, yeah, so we're placing our stop loss below it or before that level. And price is currently testing that 87.819 level at the entry. Okay, so instead, stop loss should be placed beyond it, okay, to ensure that when price hits upwards, there's room for it to reverse and hit towards our take profit that we see over here. Okay, another example. So here we're expecting price to bounce off of our entry at 87.625 and the pullback resistance that's in line with 78.6% Fibonacci retracement. So in line with our ICT strategy where we should enter our trade at the 78.6%, either 61 or 78.6. Here our entry is 78.6. Stop loss is placed at the swing high resistance and take profit is placed at our swing low support. Okay, so price hits our entry and has nicely reversed off of it and is heading towards our take profit. Okay, price touches our take profit before reversing off of it. So that's why if we had placed our take profit any lower, we would have missed this by a few pips and we would have gotten stopped out. Okay. So now that we've talked about dynamic take profit and dynamic stop loss placement, let's talk a bit about the different kinds of momentum indicators that you can use, okay, for your stop loss. So let's talk about trading stop loss. So it's a type of stop loss order that is set at a certain percentage or dollar amount away from the market price. The idea behind a trading stop loss is to lock in profits while giving the trade room to breathe, as the stop loss follows the market price as it moves in favor of the trade. So I have an example there for you to read, but it's basically useful since it allows traders to manage risk and lock in profits dynamically as the market moves. Okay, let's look at the different indicators that you can use now. So first, we use the moving average indicator. We use parabolic star, chandelier, ATR, support and resistance levels, and also a combination of all of these levels, all of these methods. Okay, so let's talk about the first method or the first example where we are using moving average. So here you can see price kind of moving in this ascending trend line, right? We have three touches. Price is making higher highs and higher lows. So we're expecting price to continue in this ascending trend line. But when you see price break out of that trend line, that's a indicator that price might continue moving in a bearish or in a downtrend. So we're going in for a sell entry, especially since when price moves above our moving average, it's a bullish signal. Once price moves below it, it is a bearish signal. Okay, so you can see price breaks under our moving average. And once price breaks above it, our trading stop loss is triggered and we get out of the trade. Okay, so you can see it's a good thing that it got us out because we would have lost all of our profits from here, from our entry until this point, um, if we didn't get out of the trade before this happened. Okay, this session is being recorded, so I'm pretty sure if you email IronFX admin, they should be able to help you out. I'm not too sure where this recording will be posted, if it's on YouTube, but you can just email I'm pretty sure the email is on the IronFX website. So just email them and I think they will be able to help you out. Okay, so next, moving on to the next indicator that you can use is trend line. So as we mentioned earlier, this is the same chart. Price is breaking out of our ascending trend line rather, and it's also moving in this descending trend line. So it's moving below. Once price breaks out of that descending trend line, we get out of the trade. Similar concept with a parabolic star. When price is moving above your indicator, it's a bullish signal. When price moves below it, it is a bearish signal. So price is moving below it, and once it moves above your parabolic star, then you can get out of the trade. It automatically gets you out of the trade. And lastly, chandelier and ATR on that same example, price is moving below, so it's a bearish signal. Once it moves above, your ATR and chandelier stop loss are both triggered and you get out of the trade. Okay. Yep. So here's another example where we are combining support and resistance with your moving average. So one way that we normally analyze is by a combination of methods so that you kind of confirm your analysis as much as possible. So here we see price breaking out of our descending trend line. Okay, price is also moving below our moving average, so it's a very bearish signal. So we're going in for a sell entry over here. Price continues to move below your moving average, and you were right, so you get your take profit here. And once price moves above your moving average, you're stopped out anyway. But you had already gotten that take profit. Okay. Another example, price moving below this ascending trend line. So it is a bearish signal going in for a sell towards our take profit here. So how can we use breakouts as your training stop loss? We did go through a couple of these examples already. But basically some steps to take note of. Breakouts are usually high volatility events. Price can spike up and reverse almost as quickly, so a stop loss will help you to manage your risk and protect your capital. Trading stop loss can help you to protect your profit, as we've seen in our previous examples as well. Okay, are there any questions so far? I do have a couple of examples on a combination of how you can. So for example, here we are using parabolic saw, support and resistance, as well as moving average, to kind of estimate where our price is headed towards. So here you see price moving in a downtrend. Once it bounces off this support level, it moves above both of the indicators. So you can go in for a buy, towards any kind of take profit level that you want. In this example as well, we're using, again, parabolic saw, moving average, and support and resistance levels. Your support and resistance levels in this example, we're basically looking at overlap levels. So overlap levels are basically levels where swing highs and swing lows line up. We're also looking at overlap and why did I forget the name? Pullback levels. So pullback level is, for example, like this one, where we have a swing high. Price breaks out of that swing high level and is now turning back to reverse back to that level. So that's how we decide where to place our support and resistance levels, basically. Yeah, so we use all of that in combination with the indicators that I've gone through already. And that's kind of it for today's webinar. Are there any questions? I didn't really go in depth with Fibonacci because we wanted to focus more on the ICT trading strategy and your risk management strategies that you can use for ICT, as well as any kind of trading technique that you wish to use. But if you were curious on Fibonacci and um, yeah, we do have a 4-part series where we go really in depth in Fibonacci and we go through many examples. So stay tuned for that. But if you want to do a bit of research on your own, you can take a look at theforexarmy.com. It's just this guide here. Yeah, we have some videos, YouTube videos that you can watch too, extensions and retracements. Okay, my Wi-Fi is kind of bad, so it's not showing up here, but it should show up for you. Um, yeah, some things to take note of. Some levels. So we have the negative levels as well, which I didn't touch on today. Today, I only talked about the retracements. So basically the mid-range, all of these levels here. Yeah, so if you want to look a little bit more in depth into Fibonacci, feel free to take a look at this website. Yep, but or just stay tuned for our Fibonacci webinar. For record, if you want the recording, I think you can email IronFX. Yeah, I think if you email them, they will either send it to you or send you a link. How to use trailing stop loss. So basically, you could use any of the methods that we gone through earlier. So like any of these. And basically, when price moves above or it breaks out of the indicator, then your trading stop loss is triggered and you're getting out of that trade. Yeah. Yeah, I'm not too sure if they'll send you the link. So I don't want to promise anything. Let me see if I can find the email. Mm, yeah, I think if you just filled this form in and told them that you want the recording to today's webinar, I think they'll be able to help you out. Yeah. Yep. That's all I have for you guys today. Thank you guys so much for joining me. If you guys liked me, feel free to follow me or connect on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. And yeah, have a great rest of your week. Bye, everyone. Take care.